SARS has adopted an accumulative method of taxing multiple lump sums received, and this applies not only to different lump sums received in the same tax year, but also where multiple lump sums are received in different tax years. That is why this calculator allows you to enter amounts into the fields for previous tax years. If this client's details have been brought forward when you imported data from the previous tax years, then any lump sums taken in previous tax years will be displayed in the previous tax years pre-populated on this screen for you. We must add together all lump sums received, and the accumulated totals will be taxed using the set of tax tables applicable to the lump sum which you indicate as having been taken last in the current tax year. You have control over which set of tables the calculator will use, and whichever T you select will decide the set of tables to be used. In cases where more than one lump sum was taken in this current tax year, then you must set the T to the set of tables applicable to the lump sum taken last in the tax year. Switching between selecting the new T buttons allows you to switch between tax tables used on the total of all lump sums taken. With different lump sums received maybe days apart in this current tax year, this may prove useful in matching the figures produced by SARS's choice of tables used. Let's say our taxpayer went on pension from a pension fund and also made a withdrawal of some of his provident fund, preferring to take the rest of the provident fund sometime in a future tax year. Let's say this taxpayer received a code 3915 lump sum of 500,000 Rand from his pension fund and also decided to take code 3920 withdrawal of 100,000 Rand from the provident fund, all in this current tax year. The code 3920 pre-retirement withdrawal of 100,000 Rand from the provident fund is entered in the resignation column. The 500,000 Rand pension lump sum is shown in the retirement column. As this 500,000 Rand pension lump sum was taken last in the tax year, we have selected the T button in the retirement column. This means the retirement benefit tax tables will be used for the accumulative total of lump sums. SARS says the amounts are both added together to make a total of 600,000 Rand, and the 600,000 Rand total is taxed as per the set of tables applicable to the lump sum taken last. We selected the retirement lump sum as being taken last, and you can see we indicate it as a T, so the retirement set of tables will be used. The first 500,000 of the lump sum amount is tax-free. The balance of 100,000 Rand is taxed at 18% to give a tax of 18,000 Rand. We now have to use the same set of retirement tables to work out the tax on all the lump sums taken prior to the lump sum taken last. This means we apply the retirement tables to the 100,000 Rand withdrawal. The first 500,000 Rand of the 100,000 Rand withdrawal amount is tax-free, so no tax is levied on the 100,000 Rand. Note that it is completely irrelevant what tax was actually levied on the 100,000 withdrawal when it was paid out. So now we have tax of 18,000 Rand on the 600,000 Rand total, less no tax on the 100,000 withdrawal, which means tax of 18,000 with due. Dragging over the auto summary screen, we can see 18,000 Rand tax due on the lump sums taken this year. What about a new case where the taxpayer went on pension last year and received a lump sum of 1.2 million from the pension fund? He then made a pre-retirement withdrawal of 500,000 Rand from his provident fund this year. The same rules apply, as SARS's accumulative method of taxing lump sums also extends across different tax years. All the lump sums are added together, and the set of tax tables used is the set of tables applicable to the lump sum taken or received last in this current tax year. The lump sum taken last was the 500,000 received as the withdrawal from the Provident Fund. The total of all the lump sums taken this year and in all previous tax years after 2009 is 1.7 million, taxed as per the withdrawal tables. The tax on 1.7 million is 459,000 Rand, less the tax that should have been deducted on the 1.2 million. It is irrelevant to the calculation what tax was actually paid on the lump sum taken previously. For the sake of this calculation, we credit the tax due of 459,000 on the 1.7 million total with the tax on the 1.2 million taxed using the same withdrawal tables. The tax on 1.2 million using the withdrawal tables will be 279,000. Subtracting the 279,000 from the 459,000 means that the tax due on the 500,000 lump sum taken in this year is 180,000 Rand. If I bring over the auto summary screen, you can see there it's telling us 180,000 Rand due on the lump sum taken this year. What if we reverse these amounts and say that the taxpayer received a lump sum withdrawal of 500,000 Rand last year and then received 1.2 million from his pension fund when he retired this year? Once again, we work out the tax on all the lump sums added together, but this time we use the retirement set of tables on the accumulative 1.7 million total. The tax is 364,500 Rand. From this, we have to subtract the tax on the 500,000 Rand lump sum taken last year using the same retirement set of tables. As this set of tables offers the first 500,000 tax-free, the tax on the withdrawal amount taken last year will be zero. Therefore, the tax on the 1.2 million amount taken this year will be 364,500 Rand less zero. And if I bring over the auto summary screen, we can see there the amount of tax required on the lump sum taken this year. One more example I'd like to show is where the taxpayer received a 300,000 Rand lump sum on retiring from his pension fund last year and then made a 200,000 Rand withdrawal from his provident fund this year. One would be mistaken in thinking that after receiving the 300,000 Rand retirement amount last year, that our taxpayer was still entitled to another 200,000 Rand tax-free in future. This would be true if the lump sum taken in the future was also a retirement lump sum. Remember that the first 500,000 tax-free only applies to retirement lump sums.